All right, I'll go ahead and get started now. So, good afternoon. Welcome to the final in our series of four Federal Grant Administration webinars. This one titled Indirect Cost Recovery for Regional Development Organizations. My name is Dion Thompson-Davley. I'm a program manager with the National Association of Development Organizations. Because our speaker has a lot of ground to cover today, if you're not familiar with NATO or our programs, I invite you to learn more by visiting our website at nato.org. Before I introduce our speaker, I want to acknowledge that this webinar series and the sessions that will follow at our conference are provided under our EDD Community of Practice initiative, which is generously supported by the U.S. Economic Development Administration. We are recording this webinar. And as I mentioned at the top, this is the final session in our four-part series. If you registered for any of the previous sessions, you should have gotten the materials in a follow-up email with links to the slides, handouts, and the recordings as well. All the materials will be available on the NATO website soon and are currently viewable on the NATO YouTube channel. In addition to the webinar series, we'll be offering two Federal Grant Administration sessions during our upcoming annual training conference, which is next week in New Orleans. One of those sessions will cover the distinction between the roles of grant recipient, subrecipient, and pass-through entity, while the other session will provide insights into the updated OMB uniform guidance. Information about those sessions and about the conference can be found on the NATO website, or if you've already registered, you can download the Whova app and view the sessions there. With that, our speaker for today's session is once again Bob Lloyd. Bob is likely familiar to any member of the NATO community, as he's been an important fixture at many of our conferences and events. Not only is Bob a respected authority on policies and practices that affect the award, administration, and oversight of federal grants, contracts, and subawards, he is also a strong advocate for the work that RDOs do and for the work that NATO does with RDOs. During today's session, Bob is open to questions. We just ask that you put them in the chat and we'll get to them at the very end in the last 15 minutes or so. And finally, before we get started, please be sure that when the webinar concludes, you fill out the evaluation that should pop up on your screen. So with all that out of the way, please join me in welcoming Bob Lloyd. Bob?
Thanks, Dion, and I appreciate the opportunity to get back with NATO and its members, albeit because we had to reschedule. A woman named Helene visited my home. Fortunately, nobody got hurt, but we do have plenty of tree damage, and we really aren't complaining too much because we know that there are lots of folks who had sustained problems as associated with the hurricane. Our focus on indirect cost in this session really has to do with the start of what I certainly have concluded is one of the most misunderstood concepts associated with federal grants management. As you can see from slide number 5, it's widely misunderstood by a lot of folks. Many awarding agency personnel, that is at the federal level, are fond of saying to grantees, your indirect costs are too high. And to which the response might be, compared to what? Because comparing indirect cost rates from one organization to another is really a fool's errand. You have to know what goes into the calculation for the individual organization. And well, there may be some comparability among organizations, particularly among regional organizations who are members of NATO. That is not something that is easily done. Recipient program staff are also guilty of misunderstanding. In many cases, they think that the amounts paid for indirect costs are somehow taking away from program activities. Yet they are often the first folks who complain that there are no paper towels in the washroom or no copy paper in the copier. Most of the media has problems with this because they try to short circuit what's really involved and often introduce concepts that belong in other sectors, such as the term overhead. And finally, many elected officials, and I guess I'm criticizing Congress here, um, are guilty of misconstruing what indirect costs are all about. I've heard, I've been in the room when a member of Congress has said indirect costs are bad and direct costs are good. Like that was a legitimate conclusion. So, trying to overcome some of that misunderstanding is often something that RDO staff has to do in order to assure that the resources are available to implement programs. If we move on to the next slide, there is related terminology. And really, if you don't take anything else away from this session, please take away the fact that program and administrative costs are not the same thing as direct and indirect cost. Program and administrative costs have to do with the underlying purpose of the expenditure, whereas direct versus indirect costs have to do with the charging practice that's appropriate for certain types of expenditures. Now, as if to emphasize this, for many years, the Office of Management and Budget, in its policies related to indirect cost, punctuated the term indirect with the acronym or F&A, standing for Facilities and Administrative Cost. And so the notion here was that those are the kinds of expenditures that are often charged indirectly because it's too much trouble to charge them on a direct basis. More on that in a little bit. As I said a moment ago, the term overhead is a term that's often introduced in the commercial sector. A Home Depot type store emphasizes the fact that it has low overhead because it's basically a warehouse full of building materials and other stuff that homeowners might want to buy. It's not comparable to Macy's department store, which is usually carrying expenditures that have to do with presentation of the goods and services available. The term back office activities is also one that sometimes gets substituted in here, recognizing that in many operations, particularly banking and other financial services arrangements, there are staff members who are working in a support role for an overall enterprise. And even in the military, the term rear echelon troops is something that comes up to demonstrate that there are certain kinds of functions that relate to support of the overall operation or mission. Turning to slide number 7, let's pull out from the applicable federal requirements the real things, the terminology that is used throughout the policy documents related to this subject. And the first one is direct costs. Direct costs are those that can be specifically identified with a particular final cost objective, such as a particular award, project, service, or other activity of an organization. Now, the notion here is that that type of cost is something that in many cases is exclusively beneficial to a particular award. We don't have many arguments about direct costs being charged in that fashion. But sometimes direct costs are charged based on a prorated basis. In other words, the cost benefits more than one activity. And there's a means that the organization has for distributing the cost among those benefiting activities so that it can directly charge those activities for those services or expenditures. Indirect costs, on the other hand, are those that have been incurred for common or joint objectives, but cannot be readily identified with a particular final cost objective without effort disproportionate to the benefit received. Now, the key words in that sentence are readily identified and without effort disproportionate to the benefit received. Translated, it's too much trouble to directly charge it. So one of the focuses here is that indirect costs are really a term of accounting convenience. We charge something indirectly because it's too much trouble to distribute it to multiple activities or to exclusively charge it to a particular objective. Now, the federal government, since before the turn of the century, has relied on those concepts to deal with the kinds of expenditures that might support a federal grant activity. And the tools for doing that are the next two terms on slide 7. Indirect cost allocation plan is a document that identifies, accumulates, and distributes indirect costs to benefiting organizational units and activities. To a large extent, the indirect cost allocation plan is a narrative document because in identifying and accumulating the costs, it is saying, here's how our organization chooses to charge this type of expenditure. Yes, it has some financial information in it, but it starts out as a narrative. What's derived from that indirect cost allocation plan is an indirect cost rate, which is a device used to determine what portion of an organization's indirect cost each activity, such as federal grant and sub-grant awards, should bear. And this is normally employed in lieu of separately negotiating that portion of indirect costs for each awarding agency. Back in the 20th century, as federal grant activity increased, the federal government concluded that having an organization have to negotiate the amounts related to indirect costs with each award was highly problematic. And particularly among colleges and universities, and then state and local governments, the idea of creating an indirect cost rate process and being able to use that on an ongoing basis within a particular fiscal period was seen to be a valuable tool. Now, on slide number 8, we start into the federal policy documents that govern this particular subject matter. And the Office of Management and Budget has issued a policy document known as Uniform Administrative Requirements, Cost Principles, and Audit Requirements for Federal Awards. The short name for that is the Uniform Guidance. And within the Uniform Guidance, Subpart E is called Cost Principles. It is in the Cost Principles section that the concepts of indirect cost are explored. And the language that I just went over with you, it was derived from those particular sections. Now, at the end of the day, at the end of a particular project or program, the amount that your organization will get to claim and keep related to a grant or sub-grant represents the sum of the allowable direct costs plus the allocable or beneficial allowable indirect costs minus any applicable credits. Now, that introduces some concepts that become very important in indirect cost recovery. The first is allowable cost, and the determination of allowable cost is done based upon policies contained in Subpart E of 2 CFR 200. Okay? The allocable allowable indirect costs represent those indirect costs that are beneficial to federal programs. Now, some of the kinds of things that are probably present in your organization's indirect cost rate are the costs of senior management, the executive director, the finance director, the human resources manager, the facilities manager, et cetera. Those individuals, their salaries, wages, fringe benefits, and other expenses benefit all the activities of the organization. And what OMB is basically saying is it doesn't make accounting sense for those individuals to have to, on an ongoing basis, distribute their costs to all of the benefiting activities within the organization. So that's where the concept of indirect costs gets operationalized. The other thing to keep in mind, and this is also in the cost principles, is the concept of applicable credits. Applicable credits are those receipts or reductions of expenditures which serve to offset costs that are charged either on a direct or indirect basis. So before you ultimately settle up on an award, things like rebates, program income, other kinds of arrangements such as that have to be deducted from the claims that ultimately are made for the projects or programs that you're administering. Now, indirect costs has gotten a lot of attention from the Office of Management Budget over the last several years as the agency has continued to refine the so-called uniform guidance. The uniform guidance was first issued and made effective by all federal agencies in December of 2014. We might call that Uniform Guidance 1.0. In 2020, as the pandemic was really raging, OMB had attempted to engage in a further revision of the requirements, but obviously was busy with other things such as the CARES Act and the American Rescue Plan Act and the like. So the changes that were made in 2020, if we want to call those Uniform Guidance 2.0, really didn't go that deep into some of the areas that have continued to be problematic policies. But coming along with what we might call Uniform Guidance 3.0, which just took effect October 1st of this year, OMB engaged in some fairly aggressive policymaking, reinforcing the idea that indirect costs charged by a recipient or subrecipient are legitimate costs that must be recognized by federal awarding agencies and perhaps more importantly, by pass-through organizations. Well, on slide 9, I'm identifying a kind of a high altitude view of what OMB has done relative to grant reform. And their focus on burden reduction and policy consolidation have certainly been part of what the discussion related to indirect costs has been all about. Back in 2013, before OMB adopted these revisions, one of the things that they suggested was that recipient organizations might be more inclined to recover indirect costs based on the election of fixed rates. Well, this was really I won't call it a ploy, but certainly a strategy to try to limit indirect cost recovery, but also to eliminate or to reduce the number of organizations that would be expected to attempt to negotiate an indirect cost rate with a cognizant federal agency, with a federal agency whose funding pattern was such that they were the predominant source of funds for that organization. The other burden reduction idea was that the indirect cost rate that was established could be employed for multiple years, longer durations. Well, a lot of recipient organizations, particularly in the state government and college and university sectors, saw through this and were highly opposed to it. But, the fact that OMB stepped back and didn't pursue it any further at that point didn't mean that they'd forgotten about it. And there's some tangible pieces of evidence to that effect in the rules that have been forthcoming ever since. Now, as I mentioned earlier, and moving on to slide number 10, the issue of allowable cost is addressed in subpart E of 2 CFR 200. I'm sure many of you are intimately familiar with that document and have probably used it as a dictionary to try to determine whether a particular cost that your organization faces is something that could be construed as allowable under the applicable cost principles. In fact, the name is indicative. These are principles to be used in determining whether a cost is allowable, not allowable, and how the costs are to be documented. Subpart E replaced a series of Office of Management and Budget circulars, which had been the repository for these types of policies in the past. But those circulars were issued based upon different kinds of organizational performers. So OMB Circular A21 was for colleges and universities. A87 was for state, local and tribal governments, and OMB Circular A122 for nonprofit organizations. Well, OMB collapsed all three of those circulars into a single document, Subpart E of 2 CFR 200. Now, there are two important aspects of that document. The first is what's known as the general tests of allowability. And these general tests apply to every cost that you might want to charge to the federal government, even if the cost is not specifically mentioned in the cost principles itself. The second component is what's known as the selected items of cost. And why were these selected? Because they either represent a type of cost that an organization customarily would encounter in the course of doing business with the federal government, or it's a type of cost that the federal government doesn't want you charging to them, or it is a type of cost that is relevant to a particular kind of performer. Well, let me give you an example of a cost they don't want you charging to them. We got along for a long time in the cost principles without mentioning booze, but OMB had to issue a policy related to alcoholic beverages because some grantees, a few, apparently in focusing on social events and other sorts of things, attempted to charge alcoholic beverages to the federal government. You can chuckle about that, but those charging federal grants can get pretty creative. In the area related to individual types of performers, there are some costs in the list of selected items that only are going to arise in a university or college setting, things that relate to student services or convocations or graduations, things of that nature. The federal government doesn't want to be paying for those either. One of the cost principles introduced in 2014 has to do with exchange rates. Well, I'm sure a lot of domestic grantees were scratching their head as why is that in here? But the federal government, through the State Department and the U.S. Agency for International Development, is frequently supporting programs, some of them performed by U.S.-based charities overseas. And those organizations convert U.S. dollars into host country currency, and in many cases sustain a gain or a loss. So how do we account for that? We account for it based upon a cost principle that OMB has issued. Now, I go into that level of detail here because there are lots of costs that are not listed at all in the selected items of cost. And that's when, interpreting the cost principles using the general tests of allowability becomes important. Now, getting over to slide 11, OMB has revised the indirect cost policies in the uniform guidance most recently, and the citations that are presented to you there on slide 11 are ones that you can cross-reference and see where it says what I'm articulating at this point. So, for example, the definitions in 2 CFR 200.1 include those that I read to you earlier related to direct cost allocation plan, and indirect cost rate. The general indirect cost policies presented in the other regulations that are cited in the second bullet primarily have to do with the federal government's intent to have negotiated indirect cost rate agreements established by a cognizant federal agency to be the gold standard in terms of indirect cost recovery. But many organizations either don't have a direct relationship with the federal government or don't receive enough federal funds to warrant their negotiation of that arrangement. So how that particular issue or that particular situation is handled is also contained in those rules. Finally, there are a few places in the selected items of cost where OMB has established that if an organization is going to charge that type of cost, it must do so directly or it must do so indirectly. There are not a lot of those, but just enough to make the statement that the recipient is the one who decides whether something is charged directly or indirectly, just enough to make that statement not totally accurate. Now, in addition to the language that I referred to that are contained in subpart E, OMB has also presented in the uniform guidance a set of performer-specific instructions for how to develop an indirect cost rate proposal and how to submit it to the federal government. And it's in this place where OMB was really not able to fully consolidate the separate sets of cost principles I referred to earlier into a single comprehensive whole. So in Appendix Roman numeral 3 of the uniform guidance, the description for how institutions of higher education handle this function is presented there. For nonprofit organizations, it's in Appendix 4, and for governmental units, it's in Appendix 5 through 7. Now, you might say, well, I'm from a governmental unit, a regional organization that's treated as a local government in our state. Why do I have to know about this? Well, I would suggest to you that if you have to be the point person in your organization who's knowledgeable about indirect cost recovery, then knowing how all of these sectors handle these functions is a useful tool. Okay, because when you come right down to it, the same concepts that are presented in the OMB definitions, that is, direct charges being something that can be specifically identified with a particular cost objective, such as a federal award, and indirect costs being those that it's more difficult to establish that sort of relationship, and it's not worth the trouble. And those kinds of concepts play themselves out within the instruction material that's in these appendices. Now, moving over to slide 13, here's where we get down to the nitty-gritty as far as recovery is concerned. If an organization obtains a federally negotiated indirect cost rate by submitting an indirect cost plan to a cognizant federal agency, having that plan reviewed and approved, and having an agreement issued, if that happens, all federal agencies are required to accept those negotiated rates. That's why I've included the citation to 2 CFR 200-414C, because that's where it says that. Now, there are only two exceptions to that. One is where there's a statutory provision that limits indirect costs in a particular federal program. Now, I hasten to add here, having an administrative cost cap in a particular program, as some programs administered by RDOs have, is not the same as having a cap on indirect cost. Those two concepts are often conflated here, okay? So the statutory exception is one where it says indirect costs are limited, not one that says administrative costs are limited. The other exception has to do with a power or an authority on the part of the head of a federal agency who can decide not to apply the negotiated indirect cost rate agreement to an organization or to all organizations, and where the head of the agency informs the Office of Management and Budget of that decision. Now, I think OMB wrote that in with the assumption that the head of a federal agency is not likely to get down in the weeds on that particular discussion. But that being said, it is one of the two exceptions that are out there. Now, perhaps something that's going to be even more important to many RDOs is this next bullet, because what OMB has said is that pass-through entities which are primary grantees who are receiving awards from federal agencies and then turning around and subgranting them to others, and those others may be RDOs, are required to accept a federally approved indirect cost rate with no exceptions. So if an RDO obtains a negotiated rate from a federal agency and then presents that in their grant application, and even more importantly, in their financial reporting, that the pass-through entity must recognize that. And OMB has made a big deal out of the fact that whenever they say must in the uniform guidance, that means it's mandatory. Now, how does that address the issue of organizations who do not have a direct relationship with the federal government? Okay. Those organizations, if they were to submit an indirect cost plan to the federal government, would probably not hear a thing from them because the feds are not going to negotiate with somebody they don't have a direct relationship with. That particular function has been devolved onto pass-through entities. So a subrecipient who wants to recover indirect cost needs to go to that pass-through entity with an indirect cost plan and a rate proposal and have that particular pass-through entity issue an agreement related to that. Now, here's the rub. That agreement is made between that single pass-through entity and the subrecipient. There's nothing in the rules that requires any other pass-through entity to recognize that negotiated rate. Now, in the revision that OMB just made effective October 1st, there is language in 2 CFR 200 332A4 that says that another pass-through entity can recognize the indirect cost rate that the initial pass-through entity negotiated. So in practical terms, let's say that you you don't have a direct relationship with the federal government, or perhaps one of your member governments doesn't. And you go to state agency A and negotiate a rate with them. And you do so based upon a submission that includes the features that are present in Appendix Roman numeral 5 and 7 of 2 CFR 200. In other words, you've put together the right plan that's properly presented. Now, that state agency A can issue an agreement with you, probably as part of your sub-award agreement, to say, we accept that. But then you go over to state agency B and say to them, well, look, we've got an agreement that was made with state agency A, and it was put together in accordance with 2 CFR 200, and we'd like for you to accept it. And state agency B can say, no, we're not going to accept it, or they can say, yes, we will. It's all up to them. And OMB has not forced their hand in terms of that particular issue. So this is where a lot of organizations that don't have a direct relationship with the federal government end up in a rock and hard place situation. Now, one other possibility relates to recovery of indirect costs for organizations that don't have rate agreements. And that's what's called the election of the de minimis indirect cost rate. Now, the term de minimis means negligible or of no consequence. It's a Latin phrase, or actually the Latin phrase is longer, but shortened to the term de minimis. OMB has established that an organization that doesn't have an indirect cost rate can charge a de minimis indirect cost rate of up to 15% of their modified total direct costs incurred in a particular award. So it's a deemed amount where they don't have to have any documentation to back it up. And they can use that as long as they want to on all of their awards. So it's a consistent practice that's involved here. Now, that 15% was bumped up October 1st from a previous 10%. And as I told you when we first started out here, one of the things OMB has been trying to accomplish over a long period of time, if you observe their practices, is to have fewer and fewer organizations having to negotiate indirect costs with the federal government. And a way to do that is to get more and more organizations to accept the de minimis rate. I hasten to add here as well that federal agencies or pass-through entities cannot force an organization to adopt the de minimis rate. That's a practice that OMB heard loud and clear about in the comment period that led up to the current revision of the uniform guidance. Now, where do you get help in putting these indirect cost allocation plans and rate proposals together? There are several federal agency, I put in quotes on slide 14, current federal indirect cost guides, okay? Several of the federal agencies have put these things together because they have significant responsibility for negotiating rates with a large cohort of organizations. I was fortunate enough to be under contract to the Department of Health and Human Services when the guide for state and local governments was put together. However, HHS has let that guide get a little out of accuracy. And in fact, the Government Accountability Office has even castigated HHS for not updating the guide more effectively. Probably for many of the RDOs listening in today, your activities are going to be centered on the next guide, the Department of Interior's Business Center, which has a set of instructions for insular areas and state and local governments. Now, the reason that that's important is that economic development districts and similar entities nationwide have been assigned to indirect cost cognizance to the U.S. Department of Commerce. And as many of you probably know, several years ago, the Department of Commerce decided to get out of the indirect cost negotiation business, even though they couldn't get out of being a cognizant agency. And their solution was to enter into an interagency agreement with the Department of Interior's Interior Business Center. So Interior does the review of indirect cost allocation plans and rate proposals on behalf of the Department of Commerce and actually issues indirect cost rate agreements under those circumstances. Okay? But there's a further policy that OMB adopted, and that is that if an organization does not receive $35 million or more in direct federal awards during their fiscal year, they're not required to submit a plan to the federal government. Instead, they're supposed to develop the plan, calculate the rate, and use the rate on their applications and on their award claims and hold it for audit. Now, where the problem comes in is that OMB's own regulation in 2 CFR 200-332A4 says that a pass-through entity or federal agency must recognize a federally negotiated rate. Well, many organizations don't have a federally negotiated rate because they haven't reached out to the Department of Interior and sought to get a rate in that situation. So this is a dilemma that certainly some of you have encountered already. A third guide that I find to be quite helpful because it's got so many examples that are well positioned and useful is the Department of Labor's Indirect Cost Determination Guide. If I were suggesting to any of you to, kind of build your capacity in this area, I would get all three of these guides and get fully caffeinated and read them to see whether there are helpful hints about how you can present your indirect cost allocation plan and rate proposal in as many circumstances as possible. Now, Department of Health and Human Services also has something that can be helpful to you as well, and that's what's called a negotiation program. If you go online to HHS's um, uh, Program Support Center, is the term of art once you get into their website, Program Support Center, and simply Google the words indirect costs negotiation programs, I think you'll find that those pop up. Now, what are these? They're checklists that the cost negotiators use to review the plans that are submitted to them. So in a sense, the negotiation programs are really the answer sheet of what kinds of things you need to be able to present as part of your submissions. Now, slide 15 gets to the issue of indirect cost cognizance. And the first thing to keep in mind, according to that last line on the slide, is this is not to be confused with the cognizant agency for audit. The cognizant agency for audit is the Inspector General's office of the agency that provides your organization with the largest amount of federal funds, whether that comes to you directly or indirectly. Arguably, that agency is the one that's most concerned about the accuracy of your audit report. Instead, indirect cost cognizance is handled by a functional office within the particular agency, and they are the ones that are responsible for overseeing your calculation of indirect costs. Well, the general rule is that the predominant source of federal funds guides that arrangement, and that is something that occurs over a sustained period. But from time to time, an organization may need to migrate to another cognizant agency. Let's say that over a 3-year period, the predominant source of funds has shifted from one agency to another. What you're supposed to do is go seek out the new agency with the predominance of funds and negotiate with them. Now, I will simply introduce the possibility that you might run into a problem here, because the agency that you've been with is, glad to see you go. The agency that you want to migrate to may not want you as an assignee. And I have had situations, including a couple involving RDOs, where the cognizant agency activity was almost a tennis match between the two agencies. Agency one didn't want you, agency two didn't want you. How did we solve that? Well, in one case, we got a member of Congress involved in the discussion, and they reached out to the Office of Management and Budget that solved the problem within a week. I don't recommend that kind of situation, but it was about the only way to solve the problem. As I indicated earlier, economic development districts have been assigned specifically to the Department of Commerce. So whether you are known as an area development district or a regional planning commission or a council of governments, the chances are pretty good that EDA in the Department of Commerce is treated as your cognizant agency. Now, the procedures for governmental units related to indirect cost recovery are derived from Appendix Roman numeral 5 and Roman numeral 7 of 2 CFR 200. In putting together a central service cost allocation plan, the organization is identifying all of the indirect costs that relate to its charging practices and assigning those indirect costs to the operational units within their organization. The indirect cost rate proposal is a derivative of that narrative discussion. And as I said earlier, this is where OMB, again, in the interest of trying to reduce the number of organizations negotiating with the federal government, has established that entities receiving more than $35 million annually must submit an indirect cost rate proposal to the cognizant agency. Those receiving less than 35 million must prepare the plan and use the rate that results and retain that for audit unless they're requested to submit specifically by the cognizant federal agency. Now, who prepares the indirect cost plan? Slide 17. There are certainly organizations out there, certified public accounting firms, consulting firms, and the like, who are offering services to organizations like yours to prepare the necessary documentation and squire that documentation to the right federal agency or pass-through entity. I'm asked from time to time to take on an assignment like that with a potential client. And I'll tell you what my normal reaction is to that. That taking on an assignment like that is kind of like borrowing your watch and telling you what time it is. In other words, my feeling is that your organization knows a lot more about your structure, your finances, the beneficial nature of the indirect costs you have, and how those relate to operational units within your organization. And all of that knowledge is something that essentially can be harnessed to be able to accomplish the necessary calculations. I think it's much better to have in-house capacity than it is to rely on outside assistance. But that's my rationale for taking that approach. There is, however, something else to be considered, and that is there's a specific restriction related to auditing firms contained in 2 CFR 200 subpart F. Explicitly 200-509B is the section involved. What it says is if the organization recovers more than $1 million of indirect cost annually, the indirect cost allocation plan and rate proposal cannot be prepared by the firm that conducts the organization's single audit. Essentially, they'd be auditing their own work. So this is a place where the independent auditor that's doing the single audit needs to part company with organizations that are helping you put it together yourself. As I suggest, I think being your own best friend in this environment is the long-term advice that I would give. Now, over on slide 18, we refer to something called your indirect cost recovery process. Where does the listing that shows up on slide 18 come from? It comes from the appendices to 2 CFR 200. In other words, those instruction documents that OMB has put together in the appendices, supplemented by the guidebooks that have been published by the various agencies that I referred to earlier, Department of Health and Human Services, Labor, and Interior. Taken together, those documents recommend this process. First, organizational review. Looking at the relationships that exist within your organization and particularly identifying any ancillary organizational components that are somehow considered to be part of the activities benefiting from the indirect costs in your organization. Secondly, documenting cost policies. Now, we can go over to slide number 19 and following to drill down on this list of steps in the process. Organizational review, where within your organization are the federal funding configurations? Are there units within your organization that do not receive and administer federal funds? Those organizational units still need to pick up their fair share of your organization's indirect costs. Your real organization chart, focusing on those central services that are supports in nature versus those that are operational. And so things like I mentioned earlier, uh, top management positions, such as executive director, finance office, human resources management, facilities management. Those kinds of things are organizational support arrangements that presumably benefit all operational activities of the organization. And what is the flow of services from the indirect support to those services? Which ones benefit and to what degree? Accounting system review. How do we establish what the expenses are to those central service units? So this is not necessarily all that complex with an organization that may be the size that your organization is. Okay. The kinds of expenses that are going to be routinely incurred within support activities would be salaries and wages and fringe benefits of the personnel who are there, supplies, equipment utilization, and facility utilization that those individuals also receive the benefit of. And those expenses to central service units are going to become part of the indirect cost pool that's distributed to all benefiting activities. Now, slide number 20 gets to another term of art that becomes very important in indirect cost recovery, and that's your cost policy statement. This is a narrative discussion of your organization's actual charging practices. So the presumption is that you're identifying whether those particular types of costs are routinely charged directly or indirectly within your system. This is one of the reasons why earlier in the presentation I said that it's not particularly useful to compare indirect cost rates from one organization to another. And the reason that it isn't is because organizations choose to charge something directly or indirectly based on a variety of factors. Okay. As we've moved more and more into the digital age, organizations have been in a position to be able to accomplish direct charging related to particular types of expenses because they've got an underlying management information system that produces that kind of data. Okay. When I started out in my career in federal funding, I worked for a regional organization, a council of governments. And one of the things that I got to do as an intern was to engage in accounting for, catch this, the cost of the photocopiers and the cost of the telephone system. Well, in those days, the information available related to those charges was very much, ancient history, organizational, keeping up with the copying cost of 75 different grant programs involved recording information in pen and ink. It wasn't something that the existing photocopiers at the time had digital capability to punch in an account code and be able to have a printout at the end of the month as to who made the most copies. Well, the same thing was true with respect to long distance telephone. And, I graduated up to more important duties later on, but that's where I learned about the difference between organizational decisions about charging something directly versus indirectly. Another example has to do with whether somebody who works on multiple activities within an organization has to break out their time according to all of those activities. At what point does it make more sense to have that individual simply record their time against an indirect cost category as opposed to charging it out to multiple projects or programs? So this is the kind of narrative discussion that a cost policy statement presents. And there's very limited federal instruction about how that's supposed to be done. But as I suggested earlier, ultimately, the decision is often going to be driven by the accounting convenience. And this is why it's also important to let people who are involved in the programmatic activities of your organization know about that cost policy statement. Because if they are developing budgets for grant applications or sub-grant applications, and they're not following your cost policy statement, that can create a significant problem in terms of even the approval of the award application. So, once a cost policy statement is developed, it makes sense to assure that it is being accomplished in a way that everybody in the organization knows how that's taking place. With respect to indirect cost charging, the next step, slide 21, is to take the allocated indirect costs and exclude any unallowables or distorting factors. So, for example, the cost of capital expenditures that are incurred within an indirect cost pool would be excluded because that's a distorting factor in terms of its allocability. Now, those guidebooks that I referred to earlier actually make some suggestions about how allocated costs are to be distributed. And this is not rocket science. It's things like determining the square footage that a particular unit occupies, and relative to other units within the organization. Looking at transactional data, for example, the cost of accounting services based upon the total direct costs of individual programs or the number of transactions that are carried out. The distribution of human resources management expenses based upon the number of full-time equivalent employees in each operational unit. Well, OMB and for that matter, the federal cognizant agencies have come up with a pretty standard kind of approach relative to that. Another aspect of what might be included in indirect cost rate, however, has to do with indirect costs that are generated within a support unit and then are actually billed out to those operational units. And these are referred to in governmental accounting as internal service funds. And the kind of approach that might be useful to deal with in the examples that are listed there on slide 21, such as fleet operations, cost of your automobile fleet that's used by staff for its activities, information technology support, and print and copy center approach. Same kind of arrangement there. Setting up a cost rate to be established based upon particular transactions. Well, the way the cost principles address this is they allow you to create a rate to be charged, let's say for mileage on the vehicle fleet, and you keep up with the number of miles driven by each federal program that you operate. And then at the end of a particular period, normally 6 months, you recalculate that rate based upon actual costs incurred. And so carrying forward the rate that was used for the first 6 months into the second 6 months might lead to an undercharge in one period and an overcharge later on in order to reconcile that. Now, it looks like we ended up with a duplicate slide there in our deck. Moving on to slide 23, the indirect cost allocation plan involves the deriving from the earlier cost policy statement and assignment of expenses to the indirect cost pools a description of the central services involved, the functions that they perform, what the benefit is to those federal awards that are being carried out, and how the indirect costs are being distributed. The item of expense that go into the plan involve exclusion of unallowables and exclusion of distorting factors. Now, once that's put together, the indirect cost rate proposal, in order to create the device that will be used going forward, takes the total of allocated indirect costs and divides it by a selected direct cost base. And because there are multiple options here, this is another reason why comparing indirect cost rates from one organization to another is not a particularly valid approach, because depending upon the base that was chosen, you can have the same indirect cost divided by either a smaller or a larger figure. Well, the options are modified total direct costs, salaries, wages, and fringe benefits, and salaries and wages. Well, if you think that through, modified total direct cost is going to be the bigger number. So if you divide the stated indirect cost by MTDC, as it's known, you're going to end up with a lower percentage rate than you would if you divide that allocated indirect cost by salaries and wages alone. So, in describing the indirect cost rate, describing it by a percentage of the base expenditures is an appropriate identification approach. Now, what has to go into the submission that would go to a cognizant agency, or that might go to a pass-through entity if you're dealing with them because you don't have a direct relationship with the federal government? The list of components that is presented on slide 25, again, is derived from those guide manuals published by the major cognizant agencies. So an organization chart with an identification of affiliated organizations, and perhaps even the need to identify different geographic locations. If an organization has multiple facilities, it may very well be that the benefit of certain indirect costs is going to be different based upon those geographically dispersed arrangements. Thinking about this in a larger context, this is one of the reasons why large universities have multiple indirect cost rates, because what they have and expenditures that occur on the main campus are different than what benefits are imposed when you're dealing with a field research station elsewhere in the state. Audited financial statements. Now, this is one of the reasons why having your most recent single audit accomplished creates reliable information that can be used by the cognizant agency to determine whether the estimates you're making about future indirect costs are accurate. There's a standard certification that has to be presented. And those of you who are familiar with the standard form 425 federal financial report, which is used for claims related to non-construction grants, will probably be familiar with the kind of language that shows up in this certification. What is different here, however, is that the standard certification that must be published is one that has to be signed by the chief executive officer or chief financial officer of the organization, stating that the indirect costs that are included are allowable and are being distributed in accordance with the procedures established in 2 CFR 200. The cost policy statement, which is the differentiation of what you charge directly versus indirectly. Narrative descriptions of the indirect cost pools, identifying how those pools benefit federal programs, the associated expenses related to the pools, and the method of allocation or distribution. Now, what you're driving at, and I know we haven't provided that to you in this this overview program, but what you're driving at is what's known as a summary schedule of the rate components. And this is where the displays that occur in the Department of Health and Human Services and Department of Labor guides can be most helpful to you. Because at this point, what you'd be doing is plugging your numbers into the template that is expected to be creating the support for your indirect cost rate. Now, just a couple of other points before we go to questions and comments. Slide 26 rounds up the issue of submission and negotiation. You've heard about the special rule for local governments receiving less than $35 million annually. What this introduces is the possibility of your organization taking it upon itself to request review of your indirect cost plan and rate proposal. In other words, to reach out to, in most cases, the Department of Interior's Interior Business Center and transmit a document that says you've prepared the plan in accordance with the requirements of 2 CFR 200. Provide a certification based upon section 200-415. And this is perhaps a place where possible independent auditor involvement might be appropriate. The independent auditor who would state that your plan has been prepared in accordance with 2 CFR 200. They didn't prepare it, but they've reviewed it sufficiently to be able to make that statement. And it may very well be that this kind of statement would come from an independent audit organization that is different from your single audit. The resulting rate agreement would be something that in turn would satisfy the requirements that exist with respect to OMB's mandatory recognition of an indirect cost rate. That language continues to be problematic if you don't get something like this accomplished. And so coping with the fact that they're not required to do a review, but can do so is certainly helpful. Now, moving over to slide 27, while this may not be an attractive situation for many RDOs, it may be the kind of thing that you need to be familiar with in order to assist your member governments, particularly those that don't receive a lot of federal funds, but would like to be able to recover any indirect costs that they generate. The de minimis indirect cost rate arrangement is something that it must be elected by the non-federal entity itself. OMB emphatically put into the uniform guidance the idea that a federal agency or a pass-through entity cannot force an organization to take the de minimis rate instead of developing an indirect cost allocation plan and rate proposal and attempting to negotiate a rate. The good thing about the de minimis rate, however, is there's no need for backup documentation. So none of the things that are involved with the steps I just went through would be expected to be carried out. And the de minimis rate can be used as long as it's desired by the applicable non-federal entity. However, at any time, that organization can decide they want to develop a plan and a rate proposal and to go forward in another path. Once that's done, then they are essentially stepping away from the ability to use the de minimis rate. The elements of a rate agreement are identified on slide number 28. The rate type, the effective date, the percentage used, the location or locations where it would be applied, the applicability to individual programs and any limitations, and how to handle any accounting changes that take place during the life of the agreement. Now, the rate types involve first what's known as a provisional/final rate. In a provisional final rate, what happens is that the rate is established based upon the beginning of a particular fiscal period. So you develop your rate proposal prior to the time the fiscal year begins. You're given a rate to be used during that fiscal year. And then at the end of the fiscal year, you recalculate your rate based upon actual costs incurred and adjust your charges accordingly. Now, this is a highly problematic approach, but it's usually used where an organization doesn't have significant history of charging indirect costs, or where there's a lot of volatility in terms of the expenses that they undertake. A predetermined rate is where the rate is established on the front end of the fiscal year, but it's not adjusted at the end of the fiscal year. So the de minimis rate is kind of a predetermined rate in its own right. Well, federal agencies are told that if they're going to establish a predetermined rate, it ought to be established at a level where it's assured that the organization involved is not going to overcharge the government. So it has some limitations associated with it. Finally, the fixed rate with carry forward is probably the most ideal, because what happens there is that the rate is established before the fiscal year starts, and it is used during the fiscal year. At the end of the fiscal year, the rate is recalculated, and then the over or under charge that results is carried forward to the next rate negotiation. Now, if you think about this, if what's happened relates to fiscal year number 1, we find out partway through fiscal year number 2 that there was an over or under charge, we're in a position to calculate or add that over or under charge into the rate calculation that will take place for year number 3. Now, not surprisingly, federal agencies will use this arrangement with organizations that have a significant and stable federal funding base. And so state governments, colleges and universities heavily engaged in research, those types of agencies are the ones that get fixed rates with carry forward. If there's been a lot of fluctuations in an organization's indirect cost calculations, it's probably not something that's going to be allowed to be used under those circumstances. Now, how the rate is actually used is it is applied, as slide 29 picks up on, in the grant or sub-grant application. Now, one of the things that OMB has done in the uniform guidance, and it's carry forward from previous policy, is if an organization has unrecovered indirect costs, it may ask the awarding agency to treat those under recoveries as part of their matching or cost sharing. Now, that requires permission of the awarding agency, but it's a way to deal with the fact that if you've under recovered, you get the benefit of the expenditures that were made in the indirect cost pool. As far as how the rate is used once programs begin, you apply the rate to the proper base of expenditures that occurs in the reporting periods that you are involved in submitting to your awarding agency. Those of you that are familiar with the standard form 425, the federal financial report that's used on direct reporting from prime grantees to the federal government, there's actually a section of the standard form 425 where the organization fills in the indirect cost rate that they are using, the base of expenditures that is involved, whether it's modified total direct cost, salaries, wages, and fringe benefits, or salaries and wages alone, and identifies how that application of the rate resulted in a particular indirect cost charge for that quarter. Okay, so perhaps in familiarizing yourself with that particular form and how that's done will give you a good idea of how this is to be carried out. Now, there may be some additional issues that come up related to the indirect cost rate and how it's operationalized. Um, Certainly, these are things that are likely to be recorded in the indirect cost rate agreement. And as a matter of fact, one thing that OMB has at least toyed with in the revisions to 2 CFR 200 is to indicate that if there are disputes between recipients and federal agencies related to indirect cost recovery, OMB will consider becoming involved in the matter. Finally, on slide 31, need to mention the issue with respect to audits of indirect cost charges. The single audit requirement is now memorialized in subpart F of 2 CFR 200. A lot of folks still refer to this as the circular A133 audit. That terminology ended in 2014, but it lives on in a few places. One of the companions to the single audit requirements in 2 CFR 200, however, is the Office of Management and Budget Compliance Supplement. And section or part 3B of the compliance supplement deals with the auditor's role in sampling and determining whether allowable costs have been incurred. Well, with respect to direct costs, the sample that the auditor pulls from particular federal programs is pretty straightforward. But with respect to indirect cost, this is where the auditor has a particular role to play in terms of verifying whether proper indirect charging occurred. If a negotiated indirect cost rate agreement is present, then the auditor can rely on that agreement as a basis for the charges that have been made. In other words, did the negotiated rate agreement get applied in the proper fashion? However, if there's not a negotiated rate agreement, then what's the auditor's role? To determine whether the rate agreement that was used was properly calculated, and then to see whether it was properly applied. So those without a so-called NICRA, their auditors have a greater role to play than those where a NICRA is present. Another reason why it makes sense to try to obtain a negotiated rate agreement with the federal government and to be able to apply that to all of your programs and activities going forward. Now, let me turn it back over to Dion and we'll open it up for your questions and comments. And I know we have a few in the chat pod.
Well, thank you very much, Bob. I'm going to go ahead and read through the questions that we have posted here. The first is from Miro, and the question is, even though the pass-through entity must recognize the indirect cost rate, the grantee has the option to not request the full indirect cost rate, right? Can you confirm that they always choose to take less or none?
No, well,
Can you
actually,
confirm they
yeah,
could always choose to take less or none if they want?
the questioner is accurate there. The fact that you've got a rate doesn't mean you have to charge the rate. Okay. If you've decided to accept less than the entitled indirect cost, that's an acceptable practice. The fact that you are doing so However, it does mean that you've got to make up the difference between the amount you're actually recovering and your rate using unrestricted funds. And if obviously if you've got those available, then it may make sense for you to do that. And it may help your competitiveness with respect to a particular award decision by an awarding agency. But there's nothing in the rules that says you must charge your rate to all programs.
All right, and then we have another question from Elizabeth. Can the 15% de minimis rate be applied for grants and costs incurred before the most recent 2 CFR 200 update, or would we still have to use the 10% de minimis rate?
The answer is the latter. What and the only place that I can identify so far that that's stated is that there's a uh, uh, there's an interagency group that OMB has formulated. It's called the COFA, COFFA, the Council on Federal Financial Assistance. And it's something that was put together about a year ago when OMB first published the proposal for the revisions. Now, what what the COFA has done is they issued a memorandum to the federal agencies back on August 15th. In that, they identified the idea, the question that you've raised, which is if you were using the 10% on an award that was in place before the effective date of the new requirements, then you have to continue to use the 10% on that award going forward. In other words, you don't pick up the 15 until you've got a new award after the October 1st deadline. So, you know, it's a different answer that would be present if you went from charging the de minimis, back in July or August, and then you went and got a NICRA. OMB has made clear that whenever you get a NICRA, you stop charging the de minimis and you're authorized to go forward with that. That's also present in that COFA memo. One of the things, I guess, since I'm making you imagine all of that, one of the things perhaps we can do is, as part of the effort to, publicize the the series, perhaps we can include that as part of the handout material that goes with the narrative on this particular session.
Certainly, we would be happy to include that. Moving to a question from Michelle. Are there good examples of cost policy statements?
Absolutely. Um, the best one I've seen is in the Department of Labor's guide that I mentioned in an earlier slide. If you go on DOL's website, um, you, you the official title is Indirect Cost Determination Guide. And so, on the public facing sheet of their website, if you Google out that wording, it'll take you right there. It's something that's issued by the Office of the Assistant Secretary for Management and Budget within the Department of Labor. But they've that I give Department of Labor a lot of credit. Their guide is one they have kept up with year in and year out. Anytime there's been a change related to the cost principles or some other kinds of policy initiatives have taken place, they have routinely updated their guide in a much more responsible way than, for example, Department of Health and Human Services. And I'm not criticizing DHHS. The Government Accountability Office did it on their own. So, they kind of rang them up and said they need to do the same sort of thing that labor has done to keep up with that. But that labor's has got a good cost policy statement that I think you can use as a guide in putting your own together.
All right, then I will move to the last question that we have here, which is from Kelly. And Kelly says, if we just got a NICRA dated October 2024, but the start date listed in the letter is January 1st of 2024, are we able to ask our federal funding agency to modify our existing award so we can apply for the NICRA rate for 2024?
If if your indirect cost rate agreement says that it's effective for January 1st, 2024, then you're entitled to use it. I mean that's probably reflective of the fact that there's often a backlog of indirect cost rate proposals that a federal agency has in front of it. And so by the time they get through the review process and are in a position to issue an agreement, a certain amount of the applicable time period has passed. And so they're reaching back and establishing that that start date and saying you were entitled to charge this indirect cost rate for charges that occurred after the effective date of the agreement. It's not something that starts with the date the agreement is issued. It's something that starts based on the year that's recorded in the agreement itself. Reason I'm so emphatic about that is I had an organization have exactly that situation, and the federal agency involved wanted them to start charging the negotiated rate based upon the timing of the release of the agreement, not the timing that the cognizant agency had put into uh, the agreement itself.
All right. Well, we are coming up on the half hour, so maybe just a quick answer on this one, Bob. Is there a good example Excel spreadsheet that you know of for calculating for calculating NICRA?
Well, the display documents that are in the HHS guide and the Department of Labor guide, I think are ones that, correspond to an Excel spreadsheet approach to the calculation. So I would look to those first and then see how that would be applied to um, your your Excel use.
All right. Well, we are at time, so I want to thank everyone for attending. As a reminder, Bob Lloyd's contact information is here on the screen. If you had any questions we weren't able to address today, please go ahead and follow up with him. If you will be in New Orleans next week for the annual training conference, we look forward to seeing you there. And if not, thank you for attending this webinar series. We will follow up with all materials by email, and they should be posted on the NATO website within the next couple of weeks. So thank you again, and everyone, please have a nice rest of your day.